It's the U.S. 10-year inflation-linked note. We're about 82 basis points. That's where we were in 2015. And the worry, of course, is breaking out of that trend.
Where are earnings now versus 2015? A lot different, number one. Number two, again, we haven't seen this type of market where we've seen rising yields and rising earnings since the 1990s, and before that really appeared in the 70s, and before that the 1960s. So, I mean, clearly people have not seen that before. And what we do in the market is we extrapolate what we know. And what do we know? I mean, we know that stocks go down because stocks will go up, because interest rates go down. That's what we know, okay? And so we're having a hard time kind of going to the next phase. Because I'm from Minnesota and I work in Canada a lot, I always try to provide some hockey terms, right?
Oh,
we're so stuck on trying to figure out and skate to where the puck is right now.
Yeah.
We're not thinking about where the puck is going to be next.
Yeah.
Right? And so we are so determined to try to define what's happening today. Yeah. And is the market going to go down today? We're forgetting about tomorrow. So what does this mean? Okay, it means this. At multiple points that we lost about 1.5 or 2 points based on next year's earnings. If you're looking at trailing earnings or earnings yield, right, E over P. If you look at E over P, you're looking at trailing earnings. So of course things are not going to look good over the last 12 months because they don't include the tax cuts or the proposed tax cuts. And oh, by the way, a lot of companies haven't put the tax cuts in their numbers yet. Okay, so the multiples actually could go down even more. Again, what does this mean? It means that higher yields are actually good for stocks. We proved it in a report that we wrote on February 1st. If you go back and look at history, as earnings go up and the stock market goes up and interest rates go up, it all works together. We used to call it the circle of life.